what's going on in the global exchange rate markets, which I think from a macro investor's perspective is always top of mind. And I think when you look at what's happening globally, there is more. We basically have gone through the last 5 years have been a pretty correlated period, and particularly across developed economies, but really globally, it's been pretty correlated. Probably China being the main outlier. And I think increasingly what we're seeing in the fundamental conditions is divergences that are functions of policy divergences. And so in particular, I think people sort of talk about U.S. exceptionalism as if it, is manna from above rather than simply a function of different policy choices in terms of how the economy is running and different structures of the economy. But this idea that, the U.S. economy continues to have higher levels of inflation, stronger nominal growth rates, which will likely lead to higher for longer monetary policy, whereas other economies, places, Europe in particular, but also Japan to some extent, are likely to have, easier monetary policy for an extended period of time, given their both structural and cyclical dynamics, is the sort of thing that will likely put pressure on the dollar to continue to be strong relative to the rest of the world. And I think cuts really counter to there's sort of this general theme that's out there in the market right now that we're going to have like a U.S. sovereign debt crisis or whatever at the time when the dollar basically hasn't been this strong in decades. And I think that divergence in policy and driven by macroeconomic conditions diverging from each other will continue to sort of emphasize the dollar relative to other developed exchange rates, which will surprise, I suspect, a lot of people over the course of the next couple of years.
Yeah, I couldn't agree more. Actually, historically, in these types of periods, what I do primarily is trade volatility and look at volatility markets. The volatility during that period in FX and gold, which by the way, I think more similar than gold is to oil, even, right? Are the assets that are the most volatile during those periods and represent the most opportunities too. So it couldn't be more historically that definitely is in line. People think that broadly all commodities are volatile during this period because they think about OPEC in the 70s, but the reality is oil was actually not very volatile. It had a very clear upward trend and didn't have a ton of volatility over the 70s and was underpinned by OPEC. So kind of that was like a Fed put essentially on oil, which really reduced volatility. So there are a lot of other assets that had volatility priced into them, which are kind of false. Whereas FX and again, gold are areas where I think calls in particular in gold and other types of hedges in FX are wonderful opportunities in the long run.